Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate filings into something you can actually understand. Today we're diving into a report from Vivos Therapeutics, and let's just say their numbers might leave you needing a CPAP machine and you'll understand the joke soon enough. Vivos Therapeutics just released their financial results, and we're going to break down what they mean. We'll look at the key numbers, see how the company is doing, and figure out what it all means for the future. Before we get started, if you enjoy getting easy to understand insights from these kinds of documents, make sure you're subscribed. We also have a Discord community link in the description below. Come check it out. This is a Form 8K, also called a current report. Companies use these to announce major events that could be important to investors. In this case, Vivos is telling everyone about their financial results for the first quarter, which ended in March. The main point of this report is to share how Vivos Therapeutics performed financially. They put out a press release about it, and this filing includes that press release as an exhibit, basically as an attachment. This section lists the documents included with the report. Exhibit 99.1 is the press release where Vivos announced their financial results. It's the main thing we're interested in. There's also something called an IXIL file, which is just a way of formatting the data so computers can read it easily. Exting now, let's dig into that press release and see what the numbers actually say. Okay, so let's get into the actual press release that Vivos Therapeutics put out. This release covers their financial results for the first 3 months of 2025. A quick note, this document was filed on May 15, 2025, so everything we're talking about has already happened. Here is an overview of their financial standing. Let's start with revenue. They report around $3.3 million in revenue for the first quarter of 2025. Now, before you think that's a ton of money, keep in mind this is for a publicly traded company, so we need to dig deeper to see if this is good or bad. The company reports a gross profit of approximately $2.3 million. Gross profit is what's left over after you subtract the cost of making their products from the revenue. To calculate the gross profit and divide it by the total revenue, and that gives us about 70%. A 70% gross margin is pretty solid. It means they're keeping a good chunk of their sales as profit before other expenses. Operating expenses include all the costs of running the business, such as salaries, marketing, and administrative costs. Vivos operating expenses totaled around $5.8 million for the quarter. This is significantly higher than their gross profit. When a company's operating expenses are higher than its gross profit, it results in an operating loss. In this case, Vivos had an operating loss of about $3.5 million for the quarter. The net loss is the bottom line. It accounts for all revenues, expenses, gains, and losses. For the first quarter of 2025, Vivos reported a net loss of around $3.4 million. Again, this is not a positive sign. Vivos had $7.6 million in cash and cash equivalents at the end of March. This is important because it shows how much money they have on hand to cover their expenses and invest in the business. Since they are losing around $3.4 million per quarter, that means they have around 2 quarters to continue business as usual before they run out of liquid assets. The company mentioned a few key areas of focus going forward, focusing on the Vivos Integrated Practice Program to encourage dentists to integrate the Vivos method, and continuing their efforts to get insurance companies to cover their treatments. Vivos has ongoing clinical studies and is developing their product line. The management seems confident that they are taking the right steps to improve the company's performance and achieve long-term growth. The key word is hopeful here. Now, let's zoom out and think about what all this means. Vivos Therapeutics is working in the area of sleep apnea and other breathing-related sleep disorders. This is a growing market as more people are diagnosed with these conditions. They are trying to solve sleep apnea without requiring people to use a CPAP machine every night. The biggest problem right now is that Vivos is losing money. Their expenses are much higher than what they are bringing in from sales. That is not sustainable for long, unless they either dramatically cut expenses or increase sales. Their gross margin is quite high, which indicates that their product pricing is high, which can either be a good thing if it's perceived as high value, or can be bad if the public is not willing to pay those high prices. It also indicates that it costs them relatively little to produce their products compared to what they sell them for. A major challenge for Vivos is getting insurance companies to pay for their treatments. If they can convince insurers that their method is effective and worth covering, it would significantly increase the number of patients who can afford their treatment. Vivos needs to show that their approach is better than existing treatments like CPAP machines and that people are willing to pay for it. Based on these numbers, Vivos is facing some real challenges and this report tells us that they have about 6 months to significantly improve their financial situation. So what do you think about Vivos Therapeutics and their prospects? Are they onto something big, or will they struggle to turn things around? Share your thoughts in the comments below. If you found this analysis helpful, please give us a like and subscribe for more deep dives into corporate filings. Also, come join the Discord community linked in the description. Thanks for watching, and we'll see you in the next video.